Hey everyone, and welcome to The Explainer. Look, if you've ever felt totally, completely overwhelmed by the stock market, trust me, you are in the exact right place. Today, we're acting as a simple tutorial for new investors. We're going to demystify the whole world of investing and look at two fundamentally different approaches to building wealth. On one hand, you've got the high-stress, nail-biting world of market timing, and on the other, the incredibly steady, automated strategy of dollar-cost averaging. $955. Just let that sink in for a second. According to a 2026 report by the National Institute on Retirement Security, that is the median retirement savings for American workers between the ages of 21 and 64. I know, it sounds absolutely crazy, but that's not a typo. We're not talking $95,000 or even $9,000, just $955. What this reveals is a really harsh financial reality. But as we're going to see through the math today, this isn't necessarily a crisis of income. For a lot of folks, it's actually a crisis of time. Specifically, it's about the amount of time people spend just waiting around to get started. So you've got to ask, why do so many hardworking, financially aware people wait so long to jump in? Well, the answer usually comes down to a super powerful psychological hurdle, and it's known as present bias. You see, present biases are deeply wired human tendency to assign way more value to right now. We treat an immediate reward or an immediate expense, like a nice dinner out, a quick weekend trip, or fixing up the car, as genuinely more important than some larger future reward. And the tricky thing is, present bias doesn't announce itself as a bad decision. No, it sneaks in disguised as being financially prudent. We tell ourselves, I'll start investing when things are just a bit more stable. But that very delay, that is exactly what ends up costing us our future wealth. All right, so how do we actually beat that bias and start building some real wealth? It all boils down to strategy. On one side of the ring, you have market timing. This is where you're actively jumping in and out of investments based on predictions, the news, or trying to catch the crazy wave of meme stocks like GameStop or AMC. It's active, it's packed with high fees, and honestly, it is a deeply stressful way to try and outsmart the entire market. On the flip side, we have dollar cost averaging, or DCA. Think of this as the passive get-rich-slow method. It literally just means investing a fixed amount of money, let's say $100, on a regular schedule, totally ignoring whether the market is up or down that day. You aren't trying to predict the future, you're just consistently participating in it. And that brings us to exactly why dollar cost averaging is such a massive game changer, all thanks to something called the compounding loop. Let's imagine a guy named Daniel. So Daniel opens a brokerage account and decides to put in $100 a month. In his first month, assuming an 8% annualized return, his interest is literally just pennies. By month 18, his account is generating about $14 a month in interest. But fast forward to year 4, and something absolutely magical happens. The interest he earned in the past actually starts generating its own interest. Eventually, that combined return grows so much that it begins to exceed his actual $100 monthly out-of-pocket contributions. The money literally starts working harder than he is. Let's break down how this snowball actually builds over a short 5-year window with just that $100 a month. If you take a really conservative approach, like using a high-yield savings account earning around 4%, your $6,000 in out-of-pocket contributions grows to about $6,630. Not bad. But if you take a moderate approach, say an S&P 500 index fund earning an 8% average, it hits $7,348. And if you go with a slightly more aggressive growth portfolio at 10%, boom, you reach $7,800. Notice how this exponential curve starts off kind of slow, but even over just 5 short years, the difference between taking zero market risk and taking moderate market risk is over $1,100. Okay, now watch what happens when we zoom out and let time really do the heavy lifting. If you dollar cost average that exact same $100 a month into a moderate 8% fund for 30 years, you will have contributed a total of $36,000 out of your own pocket. But your total portfolio value, get this, it swells to over $150,000. That means well over $114,000 of that total is pure interest earning interest. It's literally money that was never yours until you simply gave time the permission to go ahead and create it. That right there is the absolute mathematical magic of time. Now, if you're still not entirely convinced that time is way more important than the actual amount of money you invest, check out this story about two sisters. Sister 1 starts at age 25, investing just $100 a month. Sister 2 decides to wait until she's 35, when she feels a bit more financially secure, and she decides to aggressively catch up by doubling her contribution to $200 a month. Assuming both of them earn the exact same 8% return, at age 65, Sister 1 has approximately $351,000.
Sister 2, despite literally putting in twice as much money every single month, only reaches $298,000. The sister who contributed way less money in total actually retired with more simply because she started 10 years earlier. You just cannot overcome lost time.
To help you quickly figure out your own timeline, let me let you in on a fascinating little trick called the Rule of 72. This is a math hack that actually dates all the way back to a book written by Luca Pacioli in 1494. The rule basically states that to find the exact number of years it takes for an investment to double, you just divide the number 72 by your annual interest rate. So if your portfolio is returning 8%, you divide 72 by 8, which equals 9. That means your money is going to double exactly every 9 years without you lifting a single finger. How cool is that? What's really wild is how this compounding snowball just explodes over a lifetime. This is a concept you'll see heavily discussed by investors over on Reddit. If your ultimate goal is to hit $1 million, you'd probably logically think that hitting $500,000 is the halfway point, right? But in terms of time, it is a completely different story. Thanks to the exponential snowball effect, reaching your first $300,000 actually takes 52.6% of the total time on your journey to $1 million. Just let that blow your mind for a second. Accumulating your first $300K takes the exact same amount of time as accumulating the next $700K. The end of the curve isn't a snowball anymore. It's an absolute rocket ship. But we can't ignore the massive villain in our wealth building story, and that's inflation. Inflation is the silent thief that is constantly, day by day, eroding your purchasing power. If you take that $100 a month and just leave it sitting in a zero-interest bank account for 30 years, yep, you'll save up $36,000. However, if we assume a very moderate 2% inflation rate, that $36,000 is only going to buy you what $13,559 buys today. Keeping your money sitting idle guarantees that you are going to lose real value over time. You literally have to invest just to outpace the invisible tax of inflation. So how do we actually put all this into practice? How do we defeat present bias and inflation in one go? Well, the most effective behavioral trick is called pre-commitment, which really just means putting your wealth on autopilot. It's 3 simple steps. First, open a brokerage account. A Roth IRA is an unbelievable tool for this because it allows for tax-free growth, and hey, as of the 2026 limits, you can put in up to $7,000 a year. Second, set up a recurring monthly transfer that triggers the exact same day your paycheck hits your checking account. Third, do not touch it. By the time you even log in to look at your bank account, the investment is already made. You remove the temptation entirely, and you finally have momentum working for you instead of against you. To wrap up this explainer, I want to leave you with one final thought to really chew on. Are you building compound interest, or are you paying it? Because here's the thing. Compound interest doesn't care who you are. It doesn't take sides. The financial system uses the exact same exponential math for both investors and borrowers. While dollar-cost averaging investors are quietly building a fortune through market returns, credit card companies are out there extracting wealth from consumers by charging 22 to 28% APR compounded monthly. The mechanism is identical. Literally, only the direction of the money changes. So the only question that matters is, which side of the equation are you going to choose to be on? Start your compounding loop today, and hey, thanks so much for joining me to learn about building real wealth.